Hello, welcome to Tulane University's Spring 2016 Burkenroad Reports continuing coverage of Stone Energy Corporation. On behalf of my analyst team members Greg Kresko, Alex Ifkovitz, Sida Liao, Nick Rembowski, I am Josie McCann. Based on the analysis that we will discuss in the slides to come, our team has given Stone Energy an investment rating of market outperform and a 12-month price target of $3. Stone Energy stock trades on the New York Stock Exchange under the ticker symbol SGY. As is shown in the displayed charts, the company closed at a 5-year high of $49.05 at the end of April 2014. More recently, the Stone stock has had much volatility, as is evident through the 1-year stock price and volume chart. The chart shows a spike in daily volume as the date approaches March 14, 2016, which coincides with a plummeting price. Stone is currently trading at all-time lows with a close of $1.42 on February 23, 2016, just a couple weeks prior to our report's publication. We will begin our discussion with an introduction to Stone Energy and its strategy, as outlined by the company's management team. After viewing the Stone financial snapshot as our report date, March 14, 2016, we will walk through the valuation model that was created and its underlying methodology and assumptions. Finally, we will analyze the recent developments within the energy industry, specifically with regards to how oil and gas exploration and production companies have been affected. The presentation will culminate with our team's investment thesis for Stone Energy, as well as a statement on the company's recent activities in response to industry changes. I will begin with the company overview and description. Stone Energy is an independent oil and natural gas exploration and production company headquartered in Lafayette, Louisiana. Historically, Stone has operated as a shallow Gulf of Mexico driller, but has recently shifted away from shallow water in the past 5 years. Stone is involved in the acquisition, exploration, development, and operation of oil and gas properties in the Gulf of Mexico and Appalachia basins, Marcellus and Utica shales, with the bulk of its assets concentrated in the Gulf of Mexico. As of year-end 2015, the company had estimated proved reserves of approximately 57 million barrels of oil equivalent. Stone has altered their strategy since 2015 in order to survive the downturn in the cyclical oil industry. Stone is mainly focused on cash flow in the downturn. In order to salvage cash flow, Stone made steep cuts to its 2016 capital expenditure budget. Additionally, Stone shut in its Merrifield in Appalachia, which was unprofitable considering the current commodity prices. In order to prepare for the 2017 convertible notes coming due, the company borrowed the near full capacity of its revolver, $385 million. This improves Stone's cash and liquidity position significantly, but also makes the company vulnerable to a spring 2016 borrowing base reduction. As of March 14, 2016, Stone had a stock price of $1.86 and a market capitalization of $105 million. The company had a negative price-to-earnings ratio and an earnings per share of negative $19.75. Total debt to enterprise value is 0.18 times. I will now explain our target price, valuation methodology, and valuation assumptions. Our 12-month target price of $3 and rating of market outperform are based on an equal weighting of the bull and bear case using PV10 valuation methodology. The bull case is a full realization of the PV10 value. The bear case is a 50% discounted PV10 value. PV10 is the most common valuation method in the oil and gas industry. The valuation took into account the present value of the estimated future oil and gas revenues, net of estimated direct expenses, discounted at an annual rate of 10%. In order to estimate these future oil and gas revenues, we developed a reserve report for existing and proved reserves. Along with the reserve report, we took into account current production rates, forecasted decline rates, production costs, and indirect expenses. I will now explain some major trends in the oil and gas exploration and production industry. Stone Energy operates in the global oil and gas industry that produces approximately 34 billion barrels of oil and over 120 billion cubic feet of natural gas annually. Stone is a small player in the global oil and gas industry, which is dominated by large national oil companies and integrated oil companies. The bulk of these large oil and gas exploration corporations are located in countries with large oil and gas reserves, such as Saudi Arabia, Russia, Iran, and the US. Current world supply of oil and gas is noticeably greater than demand, leading to the depressed commodity price environment. One of the main contributors to the depressed commodity prices is a shift in the production strategy of the largest producer of the Organization of the Petroleum Exporting Companies, Saudi Arabia. In the last quarter of 2014, Saudi Arabia abandoned its traditional role as the swing producer. In their role as the global swing producer, Saudi Arabia increased or decreased crude oil production in order to influence prices and balance the markets. Saudi Arabia no longer acts as the swing producer, and as a result, they are now producing near full capacity. They are flooding the market with crude oil and have been a major contributor to the depressed oil prices. The massive increase in production from the United States shale plays have been brought on by advanced hydraulic fracturing and drilling techniques that have increased production around the country. New drilling and completion methods, namely horizontal drilling and hydraulic fracturing, are now utilized to recover oil and natural gas resources in shale rock formations previously thought to be uneconomic and technically infeasible. The widespread adoption of horizontal drilling and hydraulic fracturing is referred to as the Shale Revolution, which was led by smaller, pure-play exploration and production companies, as opposed to large integrated companies. The Shale Revolution has been a main contributor to the increased supply of both oil and natural gas. Our investment thesis consists of 5 main points. The falling commodity prices at multi-year lows have hit Stone hard over the past year. However, cost-cutting measures aim to ease the blow of the weak commodity environment. Stone also faces a spring redetermination on their borrowing base, coupled with 2017 convertible notes that have the potential to threaten the balance sheet. Additionally, Stone's ENSCO 8503 rig contract proves to be a costly liability. Finally, limited price protection due to minimal hedging remains an ongoing threat in 2016. We give Stone a market outperform rating with a 12-month target price of $3. I will now talk about some of Stone's recent activity. Stone addresses its liquidity concerns by drawing the $385 million remainder from its $500 million revolver. The interest rate on the $385 million is set at 5%, which will increase Stone's interest expense in the second quarter of 2016. As shown in the potential liquidity chart to the right of the screen, we estimate Stone's interest expense for the full year to be $59 million, which implies a quarterly interest expense just above $15 million in the second quarter of 2016. Stone recently hired Lazard as its financial advisor and Latham & Watkins LLP as a legal advisor. Lazard and Latham & Watkins will help Stone explore alternative financing and strategic alternatives, including asset sales and debt restructuring. The oil and gas downturn has taken a serious toll on Stone. It will be difficult to survive in this environment much longer. If Stone can solve their liquidity challenges and renegotiate with their lenders, there is likely significant upside potential for investors. If unresolved, the company faces bankruptcy risk. To conclude, we forecast a 12-month price target of $3. This implies a 61% gain from the $1.86 closing date price on March 14, 2016. The Birkenroad reports are produced solely as part of an education program at Tulane University's A.B. Freeman School of Business. The reports are not investment advice. Investors should not regard this presentation or related reports as a recommendation to sell or buy any securities mentioned. Investors should consult an investment professional and/or conduct their own primary analysis prior to making any investment decision.